There is a type of fraud that does not look like fraud. It looks like innovation. It looks like disruption. It looks like the kind of company that belongs on the cover of a business magazine. And for several years, it did. Imagine you are a regulator in Europe. Your job is to protect consumers and ensure that financial companies play by the rules. A new payments company walks into your office. The paperwork is clean. The technology is impressive. The revenue numbers are growing. The auditors have signed off. Multiple governments have granted it operating licenses. You approve it. What you do not know, what almost nobody knew, is that a significant portion of those revenues did not exist. The auditors had been shown fabricated data. The regulators had been shown fabricated data. The banks that held the company's money had been given fabricated data. And it kept working. For years. This is the story of how a company built on invented numbers convinced the most skeptical financial system in the world that it was worth billions. And what happened when one short seller, one journalist, and one stubborn regulator finally refused to look away. To understand why this worked, you have to understand what Europe's payments industry looked like in the early 2000s. At the time, the old banking system was slow. Moving money across borders took days. Fees were high. Online commerce was growing fast, but the infrastructure underneath it was still built for a world of paper checks and physical bank branches. A new company entered that gap. It positioned itself as a technology company, not a bank. It processed payments between merchants and consumers. It handled fraud detection, currency conversion, and digital transactions, all at once, all faster than the banks could. The pitch was simple and believable. The internet needed a financial backbone. Legacy banks were too slow to build it. A nimble tech company could. The early business was legitimate. The company processed real transactions. It built real technology. It attracted real customers. Investors looked at the growing revenue figures and saw exactly what they wanted to see: a European answer to the American payments giants. That credibility, built early, built genuinely, would become the most dangerous asset the company possessed. Not because it was fake, but because it was real enough to protect everything that came later. A financial company cannot operate in Europe without licenses, and licenses require regulators to trust you. This company understood that better than almost any competitor. Over several years, it cultivated relationships with financial regulators across multiple countries. It obtained payment processing licenses in major European markets. It partnered with established banks. It hired compliance officers, legal teams, and risk managers, the visible signals of a company that takes regulation seriously. It positioned itself inside the regulated financial system, not outside it. This is a key detail. Most financial frauds operate in shadows, offshore accounts, unregistered entities, anonymous ownership. This company did the opposite. It sat in the center of European financial infrastructure and dared the system to look closely. And here is the uncomfortable truth about why that worked. Regulators are not designed to catch sophisticated fabrication. They are designed to check whether the paperwork matches the rules. If the paperwork is convincing and the auditors confirm it and the banks do not raise alarms, the regulator has limited tools to dig further. The company knew exactly how deep the system would look, and it made sure the fabrication stopped just below that depth. On paper, the business model was straightforward. The company earned fees every time a transaction moved through its network. Merchants paid a small percentage. Volume was high. Revenue grew. Simple. But there was a second business line that became increasingly important: a lending and financial services arm. The company began offering loans, issuing cards, and managing escrow accounts for merchants who used its platform. This is where complexity entered the story. The company reported that it held large reserves of cash in third-party accounts, money belonging to merchants, held on their behalf as part of its payment processing obligations. These accounts, it claimed, were managed through a network of partner banks and financial institutions across several continents. The cash balances in those accounts were enormous, billions of dollars by the company's own accounting. Those balances made the company look extraordinarily solvent. When investors and auditors looked at the balance sheet, they saw a company that held far more cash than it owed. That cash balance was the foundation of the company's valuation. Remove it, and the story collapses immediately. So the question was never whether the company was growing. The question, the one almost nobody asked loudly enough, was whether that cash actually existed. The first serious questions came from short sellers. Short sellers make money when a stock falls. That gives them a financial incentive to find problems that others have missed or chosen to ignore. In this case, several research firms began publishing reports raising concerns about the company's accounting. The revenues seemed too clean. The cash balances seemed too large. The third-party arrangements seemed too opaque to verify. The company's response was aggressive. It called the reports false. It threatened legal action. It accused short sellers of manipulating its stock for profit. That response was effective. When a company attacks its critics loudly enough, many observers assume the company must have nothing to hide. After all, if the allegations were true, why would management draw so much attention to them? But that logic can run in both directions. A company with something to hide has every incentive to discredit anyone who gets close. The financial press was cautious. The company was a national champion in its home country, celebrated by politicians, praised by business media. Regulators in its home jurisdiction were not eager to investigate one of their most prominent financial technology companies based on reports written by investors who profited from its failure. There was also a structural problem. The cash balances the company reported were held in accounts at third-party institutions in countries outside the company's home regulator's jurisdiction. Verifying them required international cooperation that no single regulator had a clear mandate to pursue. The warnings sat in public view for years, uncomfortable, persistent, and largely ignored. So how exactly did the fabrication work? The company operated a complex web of subsidiaries, third-party processors, and partner banks across multiple jurisdictions. Many of these entities were obscure. Some were difficult to contact. Some appeared to exist primarily on paper. The key mechanism involved escrow accounts, large pools of cash that the company claimed to hold on behalf of its merchant clients. These balances appeared as assets on the company's books. When auditors asked for confirmation, the company provided documentation, bank statements, account confirmations, official-looking letters from financial institutions. The documents were fake. That sounds simple. But fabricating financial documents at scale, convincingly in a way that survives repeated auditing by a major accounting firm, requires something more than a printer and a forged signature. It requires either the cooperation or the deliberate incuriosity of people inside and around the system. The auditors in this case made several assumptions they should not have made. They accepted confirmations through intermediaries rather than contacting banks directly. They did not independently verify the existence of certain accounts through primary sources. In financial auditing, this is a known weakness. The system relies on honest actors providing honest documentation. When documentation is fabricated with precision, the system can fail. This is not a defense of the auditors. They are widely considered to have failed, but it explains the mechanism. The fraud did not succeed because the financial system was careless. It succeeded because someone understood exactly where the verification process had gaps and filled those gaps with false information. Investigations by a major financial newspaper eventually produced reporting serious enough that regulators could no longer treat the questions as the work of motivated short sellers. A special audit was ordered. This time, the auditors were instructed to verify the third-party cash balances directly. Not through the company's own documentation, but through independent contact with the institutions that supposedly held the money. The accounts could not be confirmed. That is the sentence that ended everything. When the auditors reported that billions of dollars in cash balances could not be verified through independent sources, the company's stock began to fall. Within days, it had lost most of its market value. The CEO resigned. The supervisory board convened emergency meetings. Regulators across multiple countries opened formal investigations. The company filed for insolvency shortly afterward. The speed of the collapse was itself revealing. A company with genuine assets does not lose its ability to operate in a matter of days. It may face legal trouble, regulatory action, or reputational damage, but its underlying business continues to function. When the cash turned out not to exist, there was nothing left to operate. The business model had depended on the balance sheet. The balance sheet had depended on the cash. The cash had never been there. For large institutional investors who had held the stock, the collapse appeared as a number on a portfolio screen, painful but survivable. For banks that had extended credit to the company based on its reported cash reserves, the exposure was more serious. Hundreds of millions in loans had been made against collateral that did not exist. Those losses had to be absorbed. Some lenders were more exposed than others. Several took significant hits. For employees, the picture was more immediate. Thousands of people who had worked for a company they believed in found themselves unemployed within days. Many had believed in the business genuinely. Some had invested their own savings in the stock. They were not part of the fraud. They were casualties of it. For the regulators, the consequences were institutional. The company's home supervisor faced intense criticism for not acting sooner on published concerns. Auditing standards for financial companies were reviewed. Questions were raised about whether national regulators were too protective of domestic financial champions. European financial oversight began a slow, uncomfortable conversation about its own structural gaps. Several individuals were eventually arrested and charged in multiple jurisdictions. Court proceedings unfolded across different countries as investigators tried to untangle which decisions were made, where, by whom, and with whose knowledge. The legal process, as it usually does, moved slowly. But the financial damage was already done. Billions in market value, hundreds of millions in unpaid obligations, a major auditing firm's reputation permanently damaged, and a hole in the European financial oversight system that had been visible to careful observers for years before anyone with authority decided to look. Every financial fraud of this scale eventually produces the same frustrated question: how did nobody catch this? But that question contains a false assumption. People did catch it. Short sellers caught it. Journalists caught it. Certain analysts caught it. The problem was not that the fraud was invisible. The problem was that the people who caught it had no power to force the system to act, and the people who had the power to act had no strong incentive to use it. This is the pattern that repeats across financial fraud. Regulators are structurally incentivized to avoid false positives. Accusing a major company of fraud incorrectly is catastrophic for a regulator. Approving a fraudulent company is less immediately costly. The failure happens later. The regulator's connection to it is diffuse, and the blame is shared widely. Auditors are hired by the companies they audit. That relationship does not make fraud inevitable, but it creates a tension that proper independent oversight is supposed to correct. Banks extending large credit lines have a financial interest in believing their collateral is real. Questioning it requires them to acknowledge a potential loss. And the company at the center of all this, it understood these incentives perfectly. It structured its deception to sit in the space between each oversight layer. Too complex for any single regulator, too internationally distributed for any single auditor, too embedded in legitimate infrastructure for any single bank to investigate from the outside. The lesson is not that Europe's financial system is uniquely broken. It is that any complex oversight system has boundaries. Those boundaries are not secret, and a sophisticated actor with enough resources and enough time can find them. The company told every regulator in Europe exactly what they needed to hear to approve it. It showed every auditor exactly what they needed to see to sign off. It gave every lender exactly enough documentation to justify the loan. It worked until someone finally asked a question the company could not answer with a fabricated document. And by then, the money was already gone. The irony of this story is not that the fraud succeeded for so long. The irony is that it succeeded because the system was designed for honest actors. Regulations, audits, bank confirmations, financial licenses, these structures were built on the assumption that the documentation people provide reflects reality. When it does not, and when the fabrication is precise enough, the entire architecture of oversight can be pointed at an empty room and told the room is full. This does not mean the system should be abandoned. It means the system should be honest about what it can and cannot verify, and who benefits from not asking. Because in finance, as in most things, the most dangerous lies are not the obvious ones. They are the ones that come with a signed audit report attached.